In 1973, Warren Buffett bought a newspaper company that everyone on Wall Street was running away from. He paid $10.6 million. 40 years later, that same stake was worth over $1 billion. And he didn't get lucky. He just followed one rule. Most people think Buffett's genius is mystical. Some secret formula. Some gut feeling. It isn't. What he did with the Washington Post in 1973 is the cleanest example we have of Benjamin Graham's principles in action. And once you see it, you can't unsee it. By the end of this video, you'll know exactly how to spot the same setup in today's market. The pattern hasn't changed in 50 years. Picture the world in 1973. The Vietnam War is still bleeding the country. The OPEC oil embargo just sent gas prices through the roof. Inflation is climbing. And the Watergate scandal is tearing the presidency apart. The S&P 500 would fall about 45% from peak to trough during this stretch. Stocks were in free fall. And right in the middle of all this sat the Washington Post Company. The very newspaper that broke Watergate. The Nixon administration was reportedly trying to revoke its broadcast licenses. Investors were terrified. The stock was trading like a company on death's door. Buffett looked at the same business and saw something completely different. He estimated the company was worth $400 to $500 million. The market was pricing it at around 80. That's the moment Graham's principles took over. But here's where it gets really interesting. Benjamin Graham taught Buffett one rule above all others. He called it the margin of safety. The idea is simple. You estimate what a business is truly worth, its intrinsic value. Then you only buy if the market price is far, far below that number. Graham would say, if you think a bridge can hold 30,000 pounds, you only drive 10,000-pound trucks across it. The gap is your protection. Against bad luck. Against bad timing. Against your own mistakes. Buffett saw that gap with the Washington Post. He wasn't paying 80 cents on the dollar. He wasn't even paying 50 cents. He was paying roughly 25 cents for every dollar of value. That's a 4-to-1 margin of safety. You almost never see numbers like that. And this wasn't a guess. The Post owned Newsweek magazine. It owned television stations in major cities. It had a near monopoly on print advertising in Washington, D.C. The business was a fortress. The market just couldn't see it through the panic. Now, here's the part most investors miss. Buying was the easy part. Holding was the hard part. Right after Buffett bought, the stock kept falling. By some estimates, his position dropped another 25% before it bottomed. Most investors would have panicked. Sold. Booked the loss. Moved on. Buffett did the opposite. He bought more. He wrote a letter to Katharine Graham, the publisher, explaining his investment philosophy. She invited him onto the board in 1974. He spent the next 4 decades teaching her and being taught by her. And the stock? It didn't recover overnight. It took years. By 1985, his stake was worth around $200 million. By the late 1990s, it was over $1 billion. When Berkshire finally exchanged its position in 2014, the total return was somewhere between 100 and 200 times his original investment. 41 years of patience. From a single decision made when everyone else was selling. And here's the lesson most people get completely wrong. You don't need to be a genius to apply this. You don't need a Bloomberg terminal. You don't need a finance degree. You need 3 things. Number 1, the patience to wait. Most years, there's nothing to do. The market is fairly priced. You sit on your hands. Number 2, the discipline to study. When you find a business you understand, you do the work. You read the annual reports. You learn the industry. You estimate what it's truly worth. Number 3, the courage to act when others are scared. Because the deepest discounts always come during the worst moments. That's not a coincidence. That's the whole point. The Washington Post wasn't a fluke. It was Graham's playbook, executed perfectly. And that playbook is still on the shelf. Available to anyone willing to read it. This is educational content, not financial advice. Always do your own research before investing. Here's the line worth remembering. Buffett didn't buy a newspaper in 1973. He bought a $400 million business for $10 million. The price was the headline. The value was the story. Once you train your eyes to separate the two, investing becomes a different game entirely. You stop chasing what's hot. You start hunting for what's mispriced. Here's a question for the comments. What's one company you understand deeply that you'd be ready to buy if its price collapsed tomorrow? Drop the ticker below. I read every comment. And if this changed how you think about market panics, hit subscribe. Tomorrow, we're breaking down the one balance sheet metric Buffett checks before reading anything else. You won't want to miss it.